In a recent Modern Retirement Monthly report, it identifies 3 strategies that can help families to reduce the tax drag on their retirement accounts. Why is that so important, and what can we do to impact our wealth potential? To help us understand these points and to break down the financial jargon, we're going to have a conversation worth your 10 minutes right now on UBS Trending. Hi, everyone, and welcome to UBS Trending. I'm your host, Anthony Pastore. With us today are my guests and colleagues from the Chief Investment Office, Ainsley Carbone and Justin Waring. So nice to have you both here in the studio. Now, I know we had you recently here on January 18th. We were discussing very specifically and in detail the Secure 2.0 Act, where it added numbers of ages for required minimum distributions from 72 to age 73 this year. And Ainsley, I want to talk with you about RMDs, particularly when it comes to what you call a tax drag. And just to remind our viewers, I would recommend, if you want, go back and watch that episode we did on the 18th of January. We go into great detail. But required minimum distributions are minimum amounts that a retirement plan account owner must withdraw annually, starting with the year that he or she reaches 72. But now with Secure 2.0, it's age 73. And if later, the year in which he or she retires. So knowing what RMDs are, Ainsley, tell us how they contribute to what you call tax drag. And I use that in quotes, as that's a term that you and Justin used in your report.
Yeah, so when we say tax drag, what it means is a reduction in your return because of the taxes that are due on an investment. So, Justin, I'm open to challenging my view on it, but the way that I think about it is with tax drag, when you're managing assets, the whole objective is to increase the likelihood of you achieving your goals. And when you do that, you need to take into consideration taxes, because taxes take away from our wealth and it makes it harder to purchase goods and services and meet those objectives. So that's why it's important to focus on taxes when it comes to managing your assets in retirement. The main reason is because of required minimum distribution. So when you have a lot of wealth in tax deferred assets and you get to age 73 or whatever your applicable age is, you have to start taking assets out, and what that means is you're forced to pay taxes. And so when you have a large tax deferred retirement account and those large required minimum distributions are big enough to push you into a higher tax bracket, that's really when it becomes much more problematic for people, and that's when they need to focus on that tax drag.
And it's taxed as ordinary income, correct?
Correct.
And what we said the last time on the show, and Justin, feel free to jump in here, is you don't have to wait to age 73 to start taking your required minimum distribution. You could start that in your 50s if you wanted to, right, Justin?
Yeah, you can take distributions for retirement expenses from age 59 and a half, but you also have the option to do what we call a Roth conversion. So there's 2 types of retirement accounts: a traditional account where you defer paying taxes on your earnings for every dollar you save into the retirement account, or a Roth account where you make a contribution after tax and it grows tax-free from that point. A Roth conversion is deciding to move money from traditional to Roth in retirement, usually. And one of the things that really comes to mind when you look at that marginal tax bracket structure that was on the screen a moment ago, the more income you have, the higher your tax rate and the larger the tax impact is going to be. So if you just defer lots and lots of income until later, you're going to push more and more income into a higher tax rate. The goal of a retirement account, its saving strategy and distribution strategy, should be to spread your taxable income from your earnings over as many years as possible to stay in the lower tax rates. This allows you to effectively get a tax cut on your earned income during your lifetime, as well as the growth of your invested assets in retirement.
So you're saying, essentially, from what I'm seeing on that chart, is you want to move your distributions to when you're bringing in less money in your earlier years, in your employment, for example.
Right. So you want to make Roth contributions in years when you've got low income, and Roth conversions in years where you have low income. So as an example, my father retired and started a consulting business early. And so many years before his RMD started, he had a window of opportunity where some years his consulting income didn't put him into a high tax bracket. He could use Roth conversions in those years in order to convert some of his IRA at a 10%, a 12% tax rate, whereas later in retirement, he's going to be in a 20, 24, maybe even 37% tax rate. And so every dollar he converts, he moves from 37% tax rate to a 12% tax rate, for example. That's 25% savings. And that's on top of the fact that we believe that there's a good chance, given the debt situation in the United States, that tax rates themselves will likely go higher in the future. So by having a mix of traditional and Roth assets and using Roth conversions to sort of shift assets when you're in lower income years, you're essentially hedging yourself against the risk of being in a higher tax bracket in the future.
And you can do partial Roth conversions in one of these types of strategies. Isn't that right, Justin?
Yeah, partial conversions is the best strategy because, every dollar you convert gets added to that year's taxable income. So you don't want to have a really big bullet tax bill in 1 year, because then, of course, you'll be pushed into a higher tax bracket.
Terrific. Thanks, Justin. So, Ainsley, one of the things that this new Modern Retirement Monthly focuses on is talking to families who are funding their spending in retirement. But you also mentioned the importance of direct savings throughout one's career. What do you mean by that?
So when it comes to saving for retirement, we typically have the option to either contribute on a pre-tax or tax-deferred basis or a Roth after-tax basis. Pre-tax, we're not paying taxes now, so it reduces our taxable income. But when we get to retirement and take that money out, that's when we owe ordinary income taxes on it. With Roth money, we pay with after-tax, we contribute with after-tax dollars. Then when you take that money out in retirement, you do not owe income tax on it. So I think it's really important to keep in mind that you need to be aware of the current allocation that you have of tax-deferred, tax-exempt, and taxable assets. Because when you get to retirement, a lot of times I'll meet with people and they'll sit down and say, okay, I have this much money in my traditional IRA. Oh, I have to start taking required minimum distributions. Oh, I have to start paying taxes on this money.
Yeah, and it's almost a bit of a shock to some people who don't know that it's coming.
Exactly.
Right.
It is a huge shock. And granted, I think a lot of the times for people retiring right now, that's the case because Roth IRAs and Roth contributions to 401ks didn't really exist, I think, until the late 90s or 2000s. But if you are working for an employer that has a 401k, or if you can contribute to a Roth IRA, I'd say think about making those after-tax contributions or those Roth contributions just so you can figure out how you can diversify the tax treatments, because the more tax diversification you have, the more options you'll have in retirement. And even if you're not contributing Roth, I think the most important thing is just to make sure that you're aware of how your assets are being taxed when adding to that account and how they'll be taxed when you take it out in retirement.
Terrific, Ainsley. And Justin, kind of piggybacking on what Ainsley's talking about here, what would you say are some of the next steps for somebody watching, even somebody who, like Ainsley just described, might be shocked to know that there are these required minimum distributions, but give us what the next steps and takeaways are here today.
So I think the most important thing is the purpose of retirement accounts is to spread your taxable income over the course of your life to try to stay in a lower tax bracket. That's something you should talk about with your financial advisor and your tax advisor on an annual basis, because your personal tax situations will change. Congress changes the rules, lots of dynamic opportunities to add value there. In our report, we also talk about qualified charitable distributions and life insurance as other ways to manage the tax drag on your retirement assets for the purposes of philanthropy or inheritance. Because at the end of the day, you want to have a lower tax rate on the funds that you need to fund your retirement spending, but it's also going to be a good idea to find the most tax effective ways to fund your charitable contributions, as well as to leave assets to the next generation. And so when we think about estate taxes on top of the income tax discussion that we've just had, the complexity goes up quite a bit. And so it's a good idea to read that report, talk about it with your financial advisor, and find out what the right solution is for you.
Terrific. Justin, thank you. I know, by the way, I always appreciate when you both come by because you take very, very complicated topics that a lot of folks have many questions on and break it down as simply as we can. I know we can't get to everything in a 10-minute show, but this was a great way to get people at least thinking about it and picking up the phone or sending an email to their advisor to help them with some of the strategies to help improve their wealth potential and avoid that tax drag as you described, Ainsley. So Justin and Ainsley, always a pleasure. Come back more. I know there's a lot of stuff going on in your world right now that you want to share with our viewers. So good to have you here.
Thank you.
Great. Thanks, Justin.
Thanks for having us.
And for more information, there's lots of content available on our website, ubs.com. UBS.com/views. Plus, you can follow us on various social media platforms like LinkedIn, Facebook, Instagram, and Twitter. Plus, all of our past UBS Trending episodes, including the previous episode I did with Justin and Ainsley on January 18th, where we go more specifically into Secure 2.0 and required minimum distributions. That can be found at UBS.com/studios and the UBS YouTube page. And if you have any questions, as we always say, please reach out to your financial advisor. Until next time, I'm Anthony Pastore. Have a great day, everyone, and remember to keep your eyes on what's trending. We'll see you soon.